Peter Lynch's rare interview, How to Invest Better Than Wall Street. Shocking secret exposed. In the early 1980s, a young portfolio manager named Peter Lynch was becoming one of the most famous investors in the world, and for a very understandable reason. When he took over the Fidelity Magellan Mutual Fund in May of 1977, his first job as a portfolio manager, the assets of the fund were $20 million. Between 1977 and 1990, he proceeded to turn it into the largest mutual fund in the world, outperforming the market by a mind-boggling 29% per year annualized. Today we're going to talk all about Peter Lynch and how he invests his money better than Wall Street. So watch the video till the end, because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. U.S. investor Peter Lynch knows how to pick stocks. During his tenure at Fidelity between 1977 and 1990, Lynch pulled off a striking feat. He grew the assets of the Magellan Fund from $18 million to $14 billion. Lynch became an icon of investing, both as a mentor to stock analysts at Fidelity and as an author of investment guidebooks read by masses of readers who have a thirst for learning about money. Lynch accomplished this by using very basic principles, which he was happy to share with just about anyone. Peter Lynch firmly believed that individual investors had inherent advantages over large institutions because the large firms either wouldn't or couldn't invest in smaller cap companies that have yet to receive big attention from analysts or mutual funds. Whether you're a registered representative looking to find solid long-term picks for your clients, or an individual investor striving to improve your returns, we'll introduce you how you can implement Lynch's time-tested strategy. Peter Lynch's 3 basic investing tenets. Once his stellar track record running the Magellan Fund gained the widespread attention that usually follows great performance, Lynch wrote several books outlining his philosophy on investing. They're great reads, but his core thesis can be summed up with 3 main tenets. Number 1. Only buy what you understand. According to Lynch, our greatest stock research tools are our eyes, ears, and common sense. Lynch was proud of the fact that many of his great stock ideas were discovered while walking through the grocery store or chatting casually with friends and family. We all have the ability to do first-hand analysis when we're watching TV, reading the newspaper, or listening to the radio. When we're driving down the street or traveling on vacation, we can also be sniffing out new investment ideas. After all, consumers represent 2/3 of the gross domestic product of the United States. In other words, most of the stock market is in the business of serving you, the individual consumer. If something attracts you as a customer, it should also pique your interest as an investment. Number 2. Always do your homework. First-hand observations and anecdotal evidence are a great start, but all great ideas need to be followed up with smart research. Don't be confused by Peter Lynch's homespun simplicity when it comes to doing diligent research. Rigorous research was a cornerstone of his success. When following up on the initial spark of a great idea, Lynch highlights several fundamental values that he expected to be met for any stock worth buying. Percentage of sales. If there's a product or service that initially attracts you to the company, make sure that it comprises a high enough percentage of sales to be meaningful. A great product that only makes up 5% of sales isn't going to have more than a marginal impact on a company's bottom line. PEG ratio. This ratio of valuation to earnings growth rate should be looked at to see how much expectation is built into the stock. You want to seek out companies with strong earnings growth and reasonable valuations. A strong grower with a PEG ratio of 2 or more has the earnings growth already built into the stock price, leaving little room for error. Favor companies with strong cash positions and below average debt-to-equity ratios. Strong cash flows and prudent management of assets give the company options in all types of market environments. Number 3. Invest for the long run. Lynch has said that absent a lot of surprises, stocks are relatively predictable over 10 to 20 years. As to whether they're going to be higher or lower in 2 or 3 years, you might as well flip a coin to decide. It may seem surprising to hear such words from a Wall Street legend, but it serves to highlight how fully he believed in his philosophies. He kept up his knowledge of the companies he owned, and as long as the story hadn't changed, he didn't sell. Lynch didn't try to market time or predict the direction of the overall economy. In fact, Lynch once conducted a study to determine whether market timing was an effective strategy. According to the results of the study, if an investor had invested $1,000 a year on the absolute high day of the year for 30 years, from 1965 to 1995, that investor would have earned a compounded return of 10.6% for the 30-year period. If another investor also invests $1,000 a year every year for the same period on the lowest day of the year, this investor would earn an 11.7% compounded return over the 30-year period. Therefore, after 30 years of the worst possible market timing, the first investor only trailed in his returns by 1.1% per year. As a result, Lynch believes that trying to predict the short-term fluctuations of the market just isn't worth the effort. If the company is strong, it will earn more and the stock will appreciate in value. By keeping it simple, Lynch allowed his focus to go to the most important task, finding great companies. Lynch coined the term 10-bagger to describe a stock that goes up in value tenfold, or 1,000%. These are the stocks that he was looking for when running the Magellan Fund. Rule number 1 to finding a 10-bagger is not selling the stock when it has gone up 40% or even 100%. Many fund managers these days look to trim or sell their winning stocks while adding to their losing positions. Peter Lynch felt that this amounted to pulling the flowers and watering the weeds. Even though he ran the risk of over-diversifying his fund, he owned thousands of stocks at certain times, Peter Lynch's performance and stock-picking ability stands for itself. He became a master at studying his environment and understanding the world both as it is and how it might be in the future. By applying his lessons and our own observations, we can learn more about investing while interacting with our world, making the process of investing both more enjoyable and profitable. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye.